What are stocks? Simply put, stock is ownership of a company. So if you own stock in Tesla, you own a portion of the Tesla company. You may have also heard of the term shares. Oftentimes stocks and shares are used interchangeably, but stock is a more general term, whereas a share is an individual unit of stock. So if I own 5 shares of Tesla, I own 5 units of Tesla stock. So cool, stock represents the ownership of a company. But how do they come to exist? For example, let's say that I own a candle business and I want to expand. I want to open up more storefronts, hire more employees, and spend some money on advertising. I estimate that I'll need $100,000 to do the expansion, but I only have $10,000 to spend, which means I need $90,000. To raise money, I convinced 9 of my richest friends to buy 1 share of my company for $10,000 each. If my company is valued at $100,000, this means that I'm giving up 90% of my company. Quick side note here, when a company first issues stock to the public, like I did with my candle company here, it is called an initial public offering, or IPO for short. Now that I have $100,000, I expand my candle business, and after a few years, the value of my company increases to $1 million. Now, each of the shares are worth $100,000.
Wow.
So now my friends and I are even richer. This was a great exchange, since I raised money for my company without having to take out a loan, and my friends who invested made $90,000 on their investment.
That's pretty good.
So the reason that companies issue shares is to raise money for the development and growth of the business. And the reason that investors buy shares in companies is to make money. Investors make money by purchasing shares in 2 ways. The first way, which we already saw in the candle business example, is through appreciation, or the increase in value of a company. The overall value of a company determines the price of a share. The second way that investors make money is through dividends. Dividends are the distribution of a company's earnings to its shareholders. Not all companies pay dividends, but if they do, they're usually based on a company's net profits, and they're typically paid out quarterly. In addition to appreciation and dividends, shareholders of a company are also entitled to voting rights. Things that are typically voted on include the election of board members, the appointment of auditors, the acquisitions of companies, and more. Now, up until this point, I've been talking about what is referred to as common stock, but there is a different type of stock called preferred stock. While both common and preferred stock represent the ownership of a company, there are some slight differences. The main difference is that preferred stock gives no voting rights to its shareholders. Additionally, preferred shareholders are prioritized when dividends are paid out. And lastly, if a company goes out of business and must liquidate their assets, common shareholders are last in line to be paid out. Preferred stock can differ from common stock in other ways, but these are the most common differences. Now, if you want to buy shares of stock in a company, you usually won't be buying it directly from the company. Instead, you'll be buying it through a brokerage from an existing shareholder who wants to sell their stake in the company. If you want to learn more about how to buy shares, I suggest checking out this video about how to invest. Leave a comment with any questions you have, and don't forget to smash the like button to support the channel.